income tax, first of its kind we are organizing, and we also welcome all the participants who have joined online and who have come here. I would now request Mr. Vivek Jalan, our chairperson of the Fiscal Affairs and Taxation Committee and partner Tax Connect Advisory Services, to please address us and take the session forward.
We have, is there a call? Online participants we cannot see. Who all are there?
Online participants, they can introduce.
Can we see the online participants? We need to see them only once for the next 2-3 minutes. You can change after that. Okay, in the meantime, since they fixed the technical glitches, let us start from here offside. So, thank you very much for joining this first of its kind, so to say, this Income Tax Act 2025 course. You have all seen the brochure, and we have designed it in a way where we'll do a section-wise analysis, right? And we have given all the sessions to different speakers so that we get a different perspective also, right? It's not possible in such a short time for 1 or 2 or even 3 speakers to cover 536 sections by and large, plus a comparison with 297 odd sections which make up to 819 sections of Income Tax Act 1961, and that also which has seen more than 79 years of jurisprudence. So, we'll have few sections today and few sections over the next few days, and also the on-site participants here. In fact, today is the day when we are launching this book on Income Tax Act 2025 with a comparison of Income Tax Act 1961 section wise. Not only that, we have also in that the select committee recommendations. Yeah. Hello. Fine. So we also have in this book the section-wise select committee recommendations, because that is important. We have not given, the entire select committee report is around 4,800 pages. It is not possible to incorporate and not necessary also to incorporate in the book. But finally, section wise, what are the select committees in those sections where they have given their comments? So we have incorporated their comments plus also some circulars section wise, right? Which are important circulars. So that book will be distributed to you, in the next few minutes. In the meantime, to start with, just a quick, very, very quick round of introduction we'll start with, and thereafter, we'll go directly to the topic. So if you can start with here. Sir, if you can, introduce yourself very briefly so that we know the demographics of the class. Can you?
Hi. Hello. Hi, good evening. Myself Shomu Banerjee. I'm from Hindalco Industries Limited. I look after treasury of Hindalco.
Hi, myself Shodi Banerjee. I'm working in Hindalco Industries Limited in the corporate treasury section. Corporate treasury section. Corporate treasury. Treasury, yes.
Yeah, hello, I am Sujit Talukdar from SL Mining and Industries Limited and working in the tax department. SL Mining.
Hi, good evening all. Myself Indranil Jana. I am from M Junction Services Limited.
From which department in M Junction?
Yeah, I'm looking after income tax.
Taxation, yeah.
Good evening all. I am Kunal Pal from Mindful Consulting. I am looking after the accounting and taxation part.
Good evening everyone. I am Shubham Kumar from Garden Ridge Shipbuilders and Engineers Limited. I am in taxation.
I am Shubhrata De. I am a practicing chartered accountant. I have got my own firm, but since Vivek is my friend, so because there is no dearth of learning, so since the act is very new, so we have to learn everything from the scratch. Thank you.
Hi, good evening everyone. I am working in Linde in taxation profile of the company.
Yeah, hi, myself Shohili Dashgupta. I am heading the accounting and taxation of Linde Group.
Hi, myself Sumit Gupta. I am from Exide Industries. I look after the direct taxation there.
Good evening, everyone. I am Gaurav Poddar, looking after finance and taxation, the Johar Group Limited.
Jorhat T. T. Prime.
I'm Ankit. I'm representing Jorhat Group as for accounts and finance.
Good evening everyone. I am Avnish Kumar and I am executive in taxation at Tax Connect Advisory.
Good evening everyone. My name is Deepak Kumar Yadav and I am from Tax Connect Service LLP. I am working in senior executive at income tax.
Yeah. Okay, so online, I think we can start with Mr. Prithanu. I can see Prithanu ji first. Mr. Prithanu, yeah. Now we can see you. Quickly, if you can introduce yourself.
Yes, sorry, I was unable to unmute it. Yeah, I'm using Prithanu Bhattacharya from Service Limited and looking after the corporates.
Yeah. Next, I think online participants, you can follow the queue. Because here we cannot see the queue.
Good evening, Vinji, and all the participants. Myself, Rashid Awad, and I'm
Thanks, Mr. Rishi.
This is Tarun Kumar Rachi from DST India. I am looking after the taxation.
Thank you,
Good
Mr.
evening
Tarun.
all. This is Pravas Kumar Roy from Primetals Technology India Private Limited. I am looking after the corporate tax.
Okay.
Good evening, sir. This is Chandan Balotia from BTLBC Limited. I am looking at accounts and finance and taxes.
This is Ayush Tibrewal from Tata Steel. I work as an area manager in the TCO Department of Direct Tax.
Okay. Okay. Next, I can see Miss Paramita Chatterjee.
Hello, sir. Good evening, all of you. I'm Paramita Chatterjee from BG Shamadar and Sons Private Limited. I'm looking after the taxation and accounts.
Okay. Mr. Chinmoy Sarkar.
Good evening, Chinmoy Sarkar from Mattis Fertilizers and Chemicals Durgapur. I am BJ Finance, look after finance accounts. Thank you.
Next, please, Mr. Rajendra.
Yeah, hi. This is Rajendra Hegde from ABB India Limited, Executive Directors. Hello, Vivek. We are faculty in the same room. So we are from ABB Bangalore, and we do tax
Sorry, I go. Sorry.
I think it's very good program you have coordinated. I think you have the first one. Jayanta Chatterjee.
Oh, yeah, Mr. Chatterjee. Can't see your name. Yeah. Next.
Good, I think it's a very good program that you have started. I think you are the first to start.
Thank you, Mr. Chatterjee. Thank you for joining too. We look forward. Next, please, online, Mr. Molloy. Mr. Molloy to. Okay, next কে আছে?
Hello, sir.
Yeah.
From Education Group. I am looking after the draft accounting and taxation for the division of the group.
Okay. I hope nobody is left. Mr. Seal is left. Yeah.
Puranjit, please take over taxation and tax.
Yeah. Thank you, Mr. Seal. So, very quickly, since we have limited time considering the gamut of the, volume of the course. Sharbani, if you can distribute the books also out here. Online participants, I am sure you have got the link for the accessing the soft copy of the book. So you can use that, and over here on site, we'll distribute the hard copies. Can you please show my PPT? Over it. Yeah. Online participants, can you see the PPT? ওখানে আসছে না PPT.
No, with it. Not yet. Not yet. No.
Okay. Yeah, now online, is it visible?
Yes.
Okay. So, let's quickly start. So this session, the initial first session, we have kept with the last section of Income Tax Act 2025, right? We'll start with the last section, that is section 536, which is on transitional provisions. And thereafter we'll go from section 1 to section 12 in the first session, which also has section 2. While we cannot go through each section, and most of the sections are a replica bearing the simplicity of language. It is a fact that the government has said, friends, that they have simplified the language primarily, and when you read through this Income Tax Act 2025, in many of the sections like section 9, which we'll go through a little bit today, you will see to understand 1961 section 9, better to read 2025 section 9, because it is much more simplified, right? Again section 5, 6, 7, which sometimes becomes a problem in 1961 Act. If you read 2025 Act, you will find it much more comprehensible, right? So it is simplified, but then when you go into the nitty-gritties, then you understand that there are some nitty-gritties in few of the sections where a change of position needs to be taken, even in the policy, even in the tax positions which you are taking, that maybe you need to change from 1st of April 2026, right? So when we started with this Income Tax Act 2025, when the bill was first tabled in the Parliament by Honorable Finance Minister on, I think, 13th of February, 12th or 13th of February 2025. Immediately after that, we had 2 or 3 webinars and seminars back to back, right? And we were discussing with the participants, with the tax professionals, as to what is there in this income tax bill. In fact, 25th of February 2025, Honorable Finance Minister was to come to Calcutta, right? And immediately thereafter, after reading the bill in the next, I think, 5 days, we made our first presentation on this Income Tax Act 2025. And in that representation itself, we had said that this section 263, you see the new section 263 of Income Tax Act 2025, that is the same as section 139 of Income Tax Act 1961. It is on filing of returns. But if you see the bill is not here now it has become an act. But if you see the bill, Income Tax Bill 2025, if you see section 263 1A9, and if you go read it with section 437, you will understand, 237, you will understand that I am talking about the bill. Now in the act, that clause has been omitted, this 263 1A9. So that clause, the way it was worded, it seemed that a person who will not file the return within the due date, he will not be getting the income tax refund. So if you don't file the return within due date, means you delay the refund even by 1 day, then you will not be getting the income tax return refund of TDS also, which has been deducted. That is what it came out way, reading that section. While again we represented, and as usual CBDT was in denial mode at that time. They said no, this is not right, this is not the intent, but we all know that assessing officers do not see the intent of the law most of the time. They just read the verbatism. So thereafter our recommendation, and many other associations after that also have recommended, and then this 263 1A9 of the Income Tax Bill 2025, that was deleted, that is not there in the Income Tax Act 2025. In April, we had a meeting with the Honorable CBDT member who was involved, CBDT Joint Secretary, who was involved in the drafting of this Income Tax Bill 2025, right? And he told us that we wanted much more recommendations, much more suggestions specifically on this income tax bill, but nothing came from the industry, nothing much came. So जैसा था वैसा ही हमने कर दिया. So friends, with this, you would understand that Income Tax Act 2025, that needs to be dwelt with, it needs to be learnt in and read in much more detail to reaffirm our tax positions, right, which we have taken. In fact, we also discussed this act with many of the income tax tribunal members, one of the most senior members, and they are all of the view that the precedents which have been set over the so many years, those precedents may be negated by this act. And if you read the nitty-gritties of this act, you will see that there is an attempt somewhat to negate the precedents. I will give you one example while it will be taken through by other faculties. If you see section 104, right? Section 104 in the Income Tax Act 2025, that is the similar to section 69A of Income Tax Act 1961, right? Income Tax Act 1961, 69A, it says, unexplained money, bullion, jewelry and any other valuable article. Now the Honorable Supreme Court, in a issue from Calcutta, it arose from Calcutta, it held that what is a valuable article? A valuable article is something which has low volume, high value, right, like diamond, low volume, high value. Now if you see the current section 104, which is apropos section 69A, they have amended this valuable, they have added in fact the word asset, unexplained asset. So asset can mean anything, right? It can mean a voluminous asset also. So, coming to the present day scenario, we have all seen so many, search surveys happening, right, in income tax, in GST, where there are some assets, there is some stock sometimes which they find out which is in excess. So unexplained stock is unexplained asset which will invoke the higher rate of tax currently under section 115 BBE, right. So again, a change in position, a change in policy, many more are there which we'll discuss one by one. But first up, you see, there are many questions which as an industry, I think most of us are from industry, even those who are in consulting space, they would understand that on 1st of April 2026, even much before that, from January itself, in our organizations, in our clients' organizations, they would ask us that what are the procedural changes which we need to do, right? Whether my income tax return for financial year 25-26, that is assessment year 26-27, whether the same ITR will be used or there will be new ITR. TDS return which I filed for Q4 of 25-26, which I will be filing after 1st April, whether it will be the current TDS returns or a new set of TDS returns. What about the TDS challan which I will be paying on 7th of April 2026? What about the TDS challan which I would be paying on 7th of May 2026? What about my Q1 20 tax year 26-27 TDS challan which I would be paying? What about on 15th of June my tax challan which I would be paying for payment of advance tax? What about in case you have a carry forward loss, right? If you have a carry forward loss in assessment year 26-27, how do you carry that loss forward, right, in the new regime? If you have a MAT credit, AMT, right, how do you carry it forward in the next regime? If you have a TDS carried forward, right, now, whenever you are filing a return, in case TDS has been deducted on advance, then you carry it forward to the next year, right, when you will offer that income for taxation, specifically in service industries, right. So how do you carry it forward? So all of these questions which arise in the minds of the taxpayers, most of these answers are there in section 536, right, which is on transitional provisions, right. Section 536 is apropos section 297 of the current Income Tax Act 1961 on transitional provisions, right. So one by one we'll go through the transitional provisions, but before that, you know, this slide, this is on 8th of December, where the Honorable Minister of Finance, the Honorable Minister of State for Finance, Mr. Pankaj Chaudhary, has replied to a query in Lok Sabha on whether the income tax returns for assessment year 26-27 would be a new set of income tax returns. I am talking about assessment year 26-27, not tax year 26-27. So he replied that a consolidated and simplified ITR form are in process of drafting and they will be notified as per provisions of Income Tax Act 1961. So while ITR forms for assessment year 26-27, that will be the under the 1961 Act, that is now clear, but new forms will come in January or February, right?
What will be the filing filing of the return date?
Filing return date again as per 1961 Act, right? Okay. Achha, one more change which you all would be knowing is this TDS returns, rectification of TDS returns correction. That limitation has been reduced drastically. So under section 200 subsection 3 of the current Income Tax Act 61, TDS statements can be rectified within anyone? How many years? 6 years, right? Currently, you can rectify your TDS statement or TDS return currently for the financial year 17-18, right? Till 31st of March 2026, you can amend till 18-19, sorry, right? But now under section 397, which is apropos section 200 of the Income Tax Act 61, under section 397, this time period has been reduced to 2 years. So this is the first to do, right? It has already come on 8th of September 2025, right? If you are not aware, on 8th of September 2025, the Ministry of Finance had issued a press release where they have stated this very clearly. We identified this before that only, that till 31st of March 2026, your TDS returns, any TDS returns which need to be rectified till Q3 of 23-24, Q3 of financial year 23-24, 31st March 2026 would be the last date for rectifying. After that, it would not be rectified, right? From 1st of April 2026, only from Q4 of 23-24 TDS returns can be rectified, right? In fact, this was very astonishing because after a lot of representation from us and other industry associations, they had brought in these 6 years for rectification. Earlier, before October 2024, there was no time limit to rectify the TDS returns. So we from associations, trade members, they represented ki arey, I take the TDS credit and thereafter a fraudulent deductor, he rectifies his TDS returns, makes it 0, and then I lose the money. So ministry we represented and thereafter they introduced the 6 years and now they want to make it 2 years, right? But nonetheless, this is some work to do. So after you go back to your offices on Monday, maybe this is the first thing in income tax which you may need to look at. Next major change, change in language, and this has been widely deliberated in the press, in the various associations, various seminars we have discussed this, notwithstanding being replaced with irrespective, right? So friends, as I said, many precedents which are already settled as of now, they are ready to be unsettled, right? And this is a clear example, notwithstanding versus irrespective, right? So CBDT had already always had the view, and we also as taxpayers, as associations, we have always deliberated that notwithstanding is the same as irrespective. Even if you see the dictionary meaning of notwithstanding, somewhere as a synonym you will get a irrespective, right? So this question was asked to the select committee, and select committee asked CBDT. CBDT said in their reply to the select committee that notwithstanding is the same as irrespective. Then again select committee asked CBDT that why don't you clarify it in the Income Tax Act 25 itself, so that any litigation which might be arising out of this petty issue, that can be put to rest. However, if you see on your screen, this is CBDT's reply. It is to be submitted that such kind of provisions cannot be dealt with by the provisions of Income Tax Bill 2025. This is fair enough. Now this is critical. It is to be dealt by the courts, right? So notwithstanding versus irrespective has to be dealt with by the courts of India, right? And while we are deliberating in a classroom setup, or even before the ministry when we go, these kind of issues when we raise, it is always said ki you raise practical issues, don't raise hypothetical issues, right? But it is a fact that the Supreme Court itself has dwelt with the word notwithstanding, and Supreme Court has said that notwithstanding word is a non-obstinate clause. Non-obstinate clause does not mean that always it does not disregard what is written before that, right? Notwithstanding only with due regard to what is written before that, it further amplifies the fact that if it is in conflict with what is written before that, then the non-obstinate clause will prevail. However, in our view, irrespective disregards what is written before that. When you say irrespective of whatever is written, this will prevail. And if you say notwithstanding what is written, that means I am having regard to what is written, but even if what is written is in conflict with what I am saying, then what I am saying will prevail. So in our view, notwithstanding versus irrespective, this also further may be dealt with by the courts. And now again, if you have two notwithstandings in the same section, right? Two notwithstandings in the same section. Honorable Andhra Pradesh High Court in the case of Tirumala Konda Plywoods has very recently dealt with two notwithstandings in the same section. And it has said that, so then the SSE said when there are two notwithstandings in that said section, then the second notwithstanding is otiose. First notwithstanding says, then second notwithstanding again. So the second notwithstanding becomes otiose. It does not have any meaning. Honorable Andhra Pradesh High Court in the case of Tirumala Konda Plywoods, it held that if the second notwithstanding is not in conflict with the first notwithstanding, both notwithstandings will prevail, right? And therefore, it upheld the revenue's plea in that case. So this is, a small warm-up of this Income Tax Act 2025, right? Now we'll go one by one on the transitional provisions, section 536. Okay, so whenever you are reading a transitional provisions, any transitional provisions, very recently, only yesterday I was deliberating on this GST rule 9610, right? And you see, so whenever a provision in a act, a provision in a statute is repealed, right? It has to also be saved, right? If a provision in a statute is repealed without being saved, then it would be considered that whatever is past and gone, that is gone, right? So, I'll not go into that particular rule, right? But this repeal and saving, if you have to read any repeal and saving in the world, you may read clause 6 of Repeal and Savings Act, right? And if you don't get your answer in section 536 of Income Tax Act 2025 on any matter, you should go to Repeal and Savings Act section clause 6, right? So, section 536(2) will take some time over here, around 20-25 minutes, because this will lay, section 536 will lay the foundation of the next 6 months in this Income Tax Act 2025. So, section 536(2)(a), it says nothing shall effect, so irrespective of the Income Tax Act 1961 and subject to subsection 3. This subsection 3, 536(3) relates to repeal and saving. It says if you don't get your answer in 536(2), go to repeal and savings, right? So, notwithstanding this, 536(2)(a), nothing shall effect the previous operation of the repealed act and orders or anything duly done or suffered thereunder, right? So, what does this mean? Whatever order has been passed in the earlier Income Tax Act 1961, all those orders will prevail, notwithstanding anything which is written in this Income Tax Act 2025. So, whatever orders you are getting in the earlier Income Tax Act 1961, whatever orders you have got, whatever orders you will be getting, you cannot take Income Tax Act 2025 as a defense that, oh, this is in conflict with the current act. Why will we take it as a defense? Why did the ministry think so? Because of Article 20 of the Constitution, which says the law which is prevailing on that day, that will prevail. Acha, can anybody tell me, in income tax, we have all been facing litigations over the last, from the day we are been practicing. There is a quantum order and there is a penalty order, right? Whenever you go through an assessment in income tax, and online participants, you can also unmute and answer. In income tax, there is a quantum order and there is a penalty order. What is the relevance of this? Why? I mean, there can be one order also. Anybody? Yeah. No, so, but that can be done in the same order also. I mean, even if you get the thing dropped, the quantum dropped in the same order, the penalty would still prevail. It has to be contested separately. Like, in GST we are doing. Even after quantum is dropped, they are going in for penalty. In fact, that is why a new section 74A has come. You are right to an extent, because in income tax, unlike, GST, there are so many sections of penalty, right? So, to an extent it is right. But friends, in fact, I was also wondering over the last 20 years that what is this, again and again 2 to appeals for the same matter, why not you can be clubbed? In fact, after reading 536 and this clause 6 of Repeal and Saving Act, little bit I got my answer. See, actually this section 297 of Income Tax Act 1961, in my view, when I read this today, it is against the Repeal and Savings Act, right? Clause 6 of Repeal and Savings Act. Why? Because in Repeal and Savings Act clause 6, it says that penalty, also any penal order, that also has to be adjudicated under the same act, right? However, when Income Tax Act 1961 saw light of day, on 1st April 1962, the 297G, I suppose, will come to that. It said that so the quantum would be adjudicated after 1st April 2026. The quantum would be adjudicated as per Income Tax Act 1922, but the penalty would be adjudicated as per Income Tax Act 1961, which came into force from 1st April 1962, right? That is why there would have been, I presume, at that point of time, cases where, there would have been no penalty, or there would have been cases where spillover cases naturally would have been cases for assessment years before 1st April 1962, where quantum orders were passed in 1922 Act, but penalty was passed after say 1964, 1965. So penalty had to be passed under 1961 Act. Possibly that is why this started and it has been continuing. That is my view now that I read, but certainly, I was not even born at that time, so, maybe seniors who were there at that time, they can give a reply to this.
Even those seniors are pretty good, but must be in the childhood days.
They would have been in the childhood days also. So 60 years, yeah. Most of the senior faculties who will come here, they are also not, I think, more than 75. So nonetheless, but in my view, this is against even the Constitution of India, right? Because Constitution also says, Article 20 says post de facto law, which says that the penalty would be applicable only on the date of the crime, or the punishment, not penalty, it says, talks about punishment, would the punishment applicable on the date of the crime, not when the crime is fructified. Punishment on the date of the crime, that would be applicable, not after 10 years when the courts hold, a person guilty. So nonetheless, this 1961 and 2025 Act, that has changed the circumstance, and now they have clarified that we will come to that provision, it just came to my mind. So they have now notified under 536(2) that penalty proceedings would also be after 1st April 2026. Whatever tax years are there, penalty proceedings would also be initiated under 2025 Act itself. A quantum and penal proceeding both under 2025 Act. So 536(2)(b) says nothing shall affect right, privilege, obligation, liability acquired, accrued, incurred under the repealed Income Tax Act or orders under such repealed Income Tax Act. So any right which you have, any privilege which you have, obligation, liability, right? Section 35D, you have taken 1/5 deduction for preliminary expenditure in this year, you have a right to take further 80% deduction going forward, right? Privilege, you have taken the privilege under section 54F, right? That you will construct a new house in the next 3 years, and therefore you have claimed that exemption. Obligation, you have to construct the new house under 54F within 3 years, right? Liability, in case you have any outstanding liability of the earlier act. So right, privilege, obligation, liability, whatever you have, All of that will be carried forward in the Income Tax Act 2025 as was there in Income Tax Act 1961. Whatever refunds were sanctioned to you, right, in Income Tax Act 1961, that will prevail. Now, when we talk about refunds, when we talk about 245, etc., etc., adjustment of refunds, now here is a tricky situation. Again, while talking to certain field formations, we all know that ITBA 2.0, which the Income Tax Department is now using, even that is little work in process, right? This Income Tax Act 2025 would require ITBA 3.0.
One small question on this. We maintain an exempted provident fund trust, which is also recognized under the old Income Tax Act.
Yeah.
Under Rule 3.1.
Yeah.
For party of the fourth schedule.
Yeah.
As per the Income Tax Repeal Income Tax Act 1961, any income from provident fund exempted under Section 1025(2). We have basically what happens is, interest on debt securities. We receive the interest post deduction of tax, I suppose.
Yeah.
So for fiscal 24-25, we have such deductions for which we have filed the tax return post the completion of our audit of accounts of our trust. Now that assessment is still due, and we are expected to get quite a substantial amount of refund. Now with the induction of this new Income Tax Act 2025, repealing the old Income Tax Act 1961, how they are going to deal with it?
Yeah. So we'll come to that. This is the start of 536. They have answered that also. So number one, refunds, you will get your refund, right? Right, privilege, obligation, liability. It is a right which is vested on you, and you see refund sanctioned under Income Tax Act 61.
No, they have not given me, we have claimed the refund.
You have claimed the refund.
So ITR 5.
Yeah.
And now that particular assessment is still due.
Yeah.
So no order has been passed so far.
I'm coming to it. So even if the order is passed, say, on 1st of May 1961, right? That order will be passed in 1961 Act. So you will get your refund. Whether you will get your refund in Income Tax Act 61 or Income Tax Act 25, that is the question. So in 536, they have said you will get it in Income Tax Act 61, right? Earlier Income Tax Act. Whatever orders relating to the period, it is not the order date, it is the period which is important. Relating to period before 31st of March 2026, all such orders will be in Income Tax Act 1961 itself, right? So appeals also under Income Tax Act 1961, whatever orders you are getting, right? We'll go one step forward. Whatever orders you get in ITA 61, appeals have to be filed via ITA 61 form only. So the appeal form 35, you will use ITA 61 form itself, right? Now, the next question is demands. If you have any demand of ITA 61, how to pay it? We'll come to that. Let us park this question. Okay, 536 2C. The provision of the repealed ITA 61 shall continue to apply to any proceedings. Photo, please bring that photo down. Okay, so I am reading this, this photo is there. So the provisions of the repealed Income Tax Act 61 shall continue to apply to any proceedings, including notices
suppose if I am having an APA which is already concluded and the period is overlapping.
Yes.
Then also both will
536 2A, it is your right or privilege granted to you.
Okay.
As was there in 61 Act, it will apply to 25 Act.
Okay. Thank you.
Okay. You have chosen the new scheme, right? 115 BAC, right? BAB, etc. Any choice which you have made, that continues, right? 536 2F, any election, declaration, option exercised in the old act, that will continue, right? Now, in this budget or in this budget only, there was an amendment where the transfer pricing officer can do a block assessment for 3 years, right? So, if he does a block assessment for 3 years, you see, possibly he will do it in the 61 Act, but again it will spill over to 25 Act, right? (536) 2G, where in respect of any proceeding relating to any tax year beginning before 1st April 26, a refund falls due, default is made. I am just reading the yellow highlighted portion. A refund falls due in the earlier period, default is made. Provisions of this act relating to interest payable by the central government on refunds and interest payable by the SSC for default shall apply for the period after the commencement of this act, right? So, 3 situations. Your a demand is made on you in March 2026, right, relating to the earlier year. You pay it off with interest in March 2026 itself. So, interest will be, although the interest rate is the same, no policy change is there, but interest has to be paid under 61 Act, right? March 2026, demand is made, you pay the interest and the demand amount, tax amount in April 2026. 50% March till March you pay under 61 Act, April you pay under 25 Act. Question, 2 challans, 1 challan, right? Again, this is something which will be answered when the rules come, but in my view, if you see, there is one more clause, we'll come to that clause, but in my view, yeah, 536 2I, we'll come to 536 2I. They say that any demand, if it is made on any tax amount, but 536 2I is saying something else. Let's see, let's read this. Any sum payable under the repealed Income Tax Act may be recovered under this Act without prejudice to any action already taken for recovery of such amount under a repealed Income Tax Act, right? So, generally I also thought that there has to be 2 challans, but for demand they are saying no, rate you have to use, policy is the same, rate you have to use of 2025 Act for the 2025 period, but challan you can use 2025 challan itself. No 2 challans are required. However, the rules will further clarify this. So, January, that is what CBDT has said.
Vivek, I just have a point. It is regarding, I think, in the previous slide, on that 115 BAC. So, will it continue for individuals as well? When once that section is selected for an option, it will continue for, they cannot change the next year.
So, it will go as per the section 115 BAC. For salaried people, you can change every year. Okay. For business people, you can change only once in a lifetime. Right privilege. Whatever was granted earlier will be granted. Now, question is whether that Form 10 ICIE in the current act, that will change, right, or whether that will remain the same. In my view, that Form 10 ICIE by which you choose, right, I think that will be changed. So if you want to change, then you may have to fill a new form when you are filing the ITR for tax year 26-27.
Thank you.
Yeah.
Tax at source on foreign payments. We are also making the provision for it in the month of March at the applicable tax rate. Now, per se, when we are doing such provision under section 195 in our books of accounts and we close it, and hypothetically speaking, there is a change in the tax rate for that particular slab or category under the new Income Tax Act 2025, and it is being, suppose it is being paid in the month of August 26, then how do you deal with that in that particular case? Because there is a change in the tax rate, there is a change in what you have considered as the provision and what you being deducted eventually in the two rates, how to deal in such scenario?
Yeah, so two issues out here. First of all, you are right, this is a hypothetical situation because ministry will never change the tax rates now. Whatever they needed to do with TDS, they have done in the past, but nonetheless, it can arise, this situation can arise. So there is no change. Even if 1961 Act had prevailed, this same situation could have arisen. The rate could have changed. So there is no change as such. Whatever provision you have made, you have to pay it. Now, which challan to use, that is a question which is a more pertinent question, right? So you have to pay this amount on 7th of April, right? 7th, the challan paying date, 30th of April. So that challan has to be 1961 challan, right? Not 2025 challan, right? Because this payment you would be doing under 1961 Act, not 2025 Act. Okay, 536(2)(h). Where any deduction has been allowed or any amount has not been included in the total income of any person subject to fulfillment. Income Tax Act 25, right? Same wordings are there, right? But 194R is copy pasted, but as of now, the circular is inconsistent with the current act. So if the income tax department does not clarify or does not come out with a master list of circulars, which they have said they will, they have said, CBDT has said to the, in an answer to the select committee, that we will come out with a clarification that all the circulars which were there in the earlier act, all of that will prevail. How they will come out with, that is something to be seen. As of now, circular is there in conflict with the act, therefore maybe a tax position needs to be changed on 1st April until unless we do not get further clarification from CBDT. Okay.
1st April 26, and that is effective post 1st April 26. So which rule will prevail? Means under which section we will say that it is means it is not a taxable transaction?
See, merger date is 20.
NCLT order, we get the NCLT order post April 26, but when we filed in NCLT, we have given a effective date which is prior to 26. Generally it takes 6 to 8 months time to pass.
So in my view, ITA 61 should prevail in that.
Okay. So then whatever asset will be transferred, so that we need to do a change in the income tax return of that period. But as you said, the return form will be changed. So how we will do that?
So again, this thing, this return and all, let the returns be notified once. Okay. Only then we will get to understand whether there is a new form for all of this, or as I had shown you, the Minister of State for Finance, he has clarified that this return forms for assessment year 26-27, that will also be changed. So possibly they are bringing in for this, specifically this demerger is a very burning issue. So they will bring in a change in that form wherein you can make the corresponding disclosures.
Okay, thank you.
Okay, so 536(2)(u), that is for faceless. So basically whatever faceless regime is prevailing, that will continue to prevail. And last 532(v), 536(2)(v), where a search has been initiated under 132 or requisition made under Tax Act, the heading is bill, this has not been changed, but what do you do for Income Tax Act 2025 implementation from now, how you plan? So first of all, in my view, an impact analysis should be done specifically on the positions taken, TDS, TCS, everything, right? Even in the income tax returns. So basically, I think whatever you have filed in the income tax returns, whatever positions you have taken, I think a relook at those positions, that is required to be done. Transitional provisions need to be thoroughly read, and whatever losses etc. are there to be carried forward, credits to be carried forward, you should be very careful while carrying forward that, because we know that in the transit phase there is lots of litigation, right? So while the ministry as of now, and rightly so, they say that you know, everything is simplified, we will not go, we want less litigation, but finally the field officers, sorry? So, I mean, we all know that every tax law, that is to collect taxes, right? Every change in tax law, that is to collect more taxes, right? And rightly so, they are also right in there, whatever they, you know, think that way, but we as taxpayers, to safeguard our own, companies, and mind that, friends, this is applicable for us individually also. So to safeguard our own selves also. So 54F, if you have taken, you have to be very, very careful that right which you have under 54F, 54, etc., that is rightly carried forward and you don't get a new income tax notice. And that will be in ITBA 3.0, which is not yet started. So you can expect some technical glitches also in ITBA 3.0. So whenever new rules, form, challans come in, that has to be studied in detail. Continuing assessment, appeals, offences and penalties, I think better. Earlier they are all closed, the better. 2025 ITA preparedness, implementation, changes in income tax portal. I think of all of this is the most important, right? Because nowadays more than law, it is the procedure which matters, and to safeguard from unnecessary issue. Impact on TDS, TCS regime, very, very important. As I said, this 194R, while they are saying that they have just carried forward, but I have told you TDS, this rectification, they have reduced the time limit. Impact on refund and liabilities. Redrafting the computation of 24-25 assessment year, 25-26 to see how it will look like in the new act. Preparing transitional forms, if any, relook at the litigations. And finally, going live, filing the last ITR for 25-26 financial year, that is assessment year 26-27. That will be very, very critical, right? Better not to revise that, better to go in with the right positions and figures. Filing the last TDS, TCS and other returns for financial year 25-26, making the first advanced tax computations under ITA 25, filing the first TDS, TCS, this will be first TDS, TCS return for tax year 26-27. This needs a change. So new tax year 26-27, filing your first Q1 TDS, TCS returns, and finally it all boils down to filing the first ITR for tax year 26-27. So this is it on the transitional It is received, no? In IT. And received also, no? So that is deemed. But received basis, so you have to pay. Yeah, just hold on. Paid. New. Paid. Here is also there. That don't worry. Income tax department will not leave. Okay, so again, this is, in my view, this is a policy change. I'm not sure whether, that department has taken cognizance, because select committee's comments on this 240 is no substantive deviation, right? Hearing, section 248, select committee has said same position. ICDS has been defined, income computation.
But it failed. Okay, so do I need to pay tax? Means maybe it failed after the financial year end or tax year ends. Then do I need to pay tax on the declaration even if that did not happen, doesn't happen afterwards?
I think if it is crystallized that it didn't happen before you paid the advance tax, or if you file the return, I don't think you have to pay the tax over there.
Yeah, but suppose I do it in the month of April or March, means first March, but I don't know, there is a timeline given 3 months, so I don't know at that time that whether it will be crystallized or not. What stand should we take?
No, this is a tricky situation. Again, this this will be taxed as dividend in the hand of the recipient.
Yeah.
So you as a recipient has to take a stand on 15th of June, right? When you are making the advance tax payment.
Or the last 15th of March.
Yeah.
The
last week of March.
Yeah.
So in case it is a tricky situation, but you as a recipient, how do you know that it is a tricky situation?
Right.
So you end up paying advance tax and then taking a refund of it.
Okay.
Okay, so non-resident has been defined separately, not much. I will go 50. Okay, so one in slump sale, I have a view. I mean, this is a far-fetched view, but there is one change. So slump sale definition 203, there is no difference, but 50B slump sale, right? That is apropos the current. This is ulta. 61 is left, 25 is right in this slide, because I'd find it out before this year. So in slump sale, they have added a word division, right? Section 7. change remains the same. They have included all the deductions of political parties under section schedule 8. Select committee has also said this. So I think this is it in the preliminary till section 12. Thank you very much for your hearing. We have the other faculties also over here. We have answered some questions. If you have more questions, online participants, you can also type in your chat box. From Bengal Chamber, we'll consolidate these questions and we'll try to answer it either online during the class or offline with the faculties can answer it and we'll send it across to you. So thank you very much and over to Sharbani.
Thank you. Now we will have a short break of 15 minutes so you can have some snacks. And we have already shared the presentations, today's presentation. So hope you have received the presentation. Yeah, okay. If you want to continue questions, they can serve here. Okay. Okay, so we are arranging to serve inside, just allow us for some time.
Can it be served here or you think getting up for 5-10 minutes would help?
You take a break for 5-10 minutes, we will serve the snacks in the next session.
Yeah.
You take a break for 5-10 minutes, okay? Can I request all the participants for a group picture, please? Yes, along with the other faculties. We welcome Mr. Vikas Jain, Associate Partner from Pricewaterhouse Company, LLP, and Ms. Megha Dandania, Manager from Pricewaterhouse. I request Mr. Jain and Ms. Megha, please to take the session forward.
Thank you, and good evening, everyone. First of all, excellent session by Vivek ji. I think it was like running past each and every provisions of 1961 vis-a-vis 2025. I think it was a learning by me as well sitting there. So considering that in the first session already a prelude to the introduction of the Income Tax Act 2025 has already been given. So in the interest of time, I may not repeat as to how the Act has seen the light of the day. Having said so, it is important to mention that the new Income Tax Act is indeed a welcome step in the right direction. I mean, it has been acknowledged by everyone, including the higher judiciary, that how complex the tax provisions are. Even at times, the Indian highest judiciary have found it difficult to comprehend the intricacies and or complexities of the current law, let alone the normal taxman. Though the multiple attempts have been made to rewrite the law or rewrite the law in the past, but it has never seen the light of the day. Even if you recollect, Direct Tax Code 2009 was shelved after many years. If you go through the provisions of 2025, it is very clear that a mandate was given to the draftsman not to make any policy or fundamental related changes. Given this limitation, you see that the draftsman had indeed done a very good task by reducing the number of the words, eliminating hundreds and thousands of provisos and or explanations, and making the law look simple. Now, hopefully, most probably if you go and see the provisions, you will find that there are not very significant changes, but if you fine tune into each of the provisions, you will find the intricacies and there could be interpretational issues when you just deep dive each sections very carefully. Having said so, whether the law eventually ends up being simplified or would lead to more litigation is something only the coming years would say. Now, overall basis, if you see the current Income Tax Act 1961 comprises of more than 5 lakh words. The 2025 Act is almost half, nearly 2,58,000 or 2,59,000 words a day. If you see the 1961 Act, it has, considering all the sections like 115A and all and adding up, there are more than 816 sections. Current Act only has 536. So a Herculean task, it was a Herculean task to redraft or rewrite a living law like income tax, wherein there is a wealth of judicial precedents as well as the history. So with this background, if we come to the current topic that we will discuss in this session, which are the heads of income. So overall, structurally, the 2025 Act retains the 5-head structure. Even though initially there was a discussion that you increase the heads to 16, and my colleague Megha will take you through as to how the select committee and eventually the ministry and all address that question as well. But finally, it was only the 5-head structure, because the reasoning that was given and also mentioned in the first session, that let's avoid any policy level changes, high level policy level changes and not fundamental changes, and hence the 5-head structure was retained. So now talking about salaries, income from house property, profits and gains in business and profession, capital gains and income from other sources. Now, if you look into most of these changes and all, you would find that these are textual, structural changes have been made, but the changes are not substantive. Having said so, if you go through the salary section, you will find that the way the sections has been mentioned, most of the sections or this chapter has been consolidated so that it aids and helps the taxpayers not to look into various other chapters. Currently, when a taxpayer is filing his or her tax return, there are times wherein you are going to section 10, you are going to other chapters and all. But the way the current salary provisions has been drafted in 2025 Act, it has been the intention that a normal citizen of India could find, a normal taxpayer could find all the sections at one place, and hence enabling him to file his tax return compliances as well in a very simplified manner. Just to collated and or consolidated at one place. Just to give you an example, that sections like provisions like for gratuity or leave encashment, which you earlier find mentioned in section 10, had relevance to salary taxation as well. Now you will find under the salary head only. Talking about some of the high level changes before my colleague Megha takes you through the each section wise changes and differences between the 2025 vis-a-vis the 1961, you would find that the current salary provision, the 1961, talks about an entertainment allowance for government employees. Now this has been done away with. If you see one of the major structural changes one may find in the definition of profits in lieu of salary, wherein there is a specific exclusion in the 1961 Act with respect to gratuity, commuted pension or retrenchment compensation. But now under section 18 of the 2025 Act, it is included there as well. The reasoning is that first you add it up in the gratuity, considered in the gross gratuity, it is not exempt as it was in the 1961 Act, and then you claim the deductions as per section 19 of the new 2025 Act. So even provisions like gratuity, commuted pension, retrenchment compensation and all will now form part of the gross salary, and then you claim the deductions and all as per the section 19 of the Income Tax Act. So this is one of the structural changes. Coming to few changes in the income from house property head, you would see the current section 27 mentions that transfer of any house property for inadequate consideration to your spouse or to a minor child, you will be considered as a deemed owner. So even if you have transferred the house property to your wife or the spouse and or the minor child, you will be considered to be the deemed owner. So the usage of the words in the current act is transfer of house property for inadequate consideration. Now if you see the 2025 Act, it only mentions transfer of any property. Now it may raise eyebrows that it only mentions it has been widened, but somehow if you get into the intricacies of the provisions and all, maybe this change may not have any impact, because in any case section 25 of 2025 Act talks about computation under the head income from house property only. So even at the first glance these provisions look that it would capture or bring under its ambit any other property as well, but that may not be the case eventually. Now coming into profits and gains and business and profession, and if you see the major changes has been with respect to the flow of sections. I think it has been made concise to improve coherence as well as the logical links has been created. The provisions dealing with presumptive taxation for residents as well as non-residents have been merged to help the audience or the reader or the taxpayers better readability as well. Now another change was with respect to similar topics, like when you look into the deduction of employee welfare related sort of a deductions, the provisions are pretty scattered in the current 1961 Act. So even topics which are similar, the intention of the draftsman has been that you bring down all the scattered positions at one place, so that even such provisions has been brought into in one place and you will find it at one place rather than going or finding another sections in another chapter and all. Now if someone looks into the current definition in the 1961 Act of the written down value, you would find it is very complex, and even the legal experts would find difficulty in going through the written down value sort of a provision which is currently there in the 1961 Act because of lot of explanations, provisions and all amendments taking place. Now what this 2025 Act has done, such complex definitions and of such complex concepts has been provided either in a tabular way or in a formula based approach. So even if you look into the gratuity sort of computation and all, which maybe by reading sentences and all we need to infer as to what should be the amount, the current Act 2025 Act puts that in a formula based and not a tabular approach, so that it is very easy for the taxpayer to comprehend the section, as it was not the case earlier in the 1961 Act. One may say that there are no substantive changes. Having said so, there is no denying the fact that the law has been simplified to a greater extent. Now, if you look into section 28 of the 1961 Act, it says that the export incentives will be taxable, and if you look into the section, the way it is currently drafted, it also mentions the schemes under which these export incentives has been received, and this will be taxable. The 2025 Act has done away with mention of any of the schemes. So maybe the provisions has been broadened and it looks like that any export incentives can be brought under the ambit of taxation. Now, another change with respect to depreciation, an important one. I mean, if you see on a high level basis, there has been no rate sort of a changes or eligibility sort of a changes in the depreciation provisions. But if one looks into the way the additional depreciation clause has been drafted, I think it puts a strenuous clause there, making it a bit difficult for the taxpayers to claim going forward, provided if the conditions are not met. Currently, under the 1961 Act, if you see, there is no requirement or explicit mention that the new plant and machinery will have to be first put to use for the purpose of the business. It has put to use criteria is there, but a specific mention of the word first put to use, as if even if it was put to use for some other case and then it has been put to use, one may consider claiming the additional depreciation under the current law. But if you see the additional depreciation clause under the 2025 Act, it clearly mentions that the plant and machinery, the new plant and machinery has to be first put to use in the business. So the word first has been added, whereby it means that maybe some bit of an additional criteria or checks and balances has been imposed while claiming this additional depreciation. Yeah. first-hand assets, but the uses of the word first means maybe, and it has been provided by you of an example as well in the Master Guide to Income Tax Act 2025 and all, as to maybe that asset which was a new plant and machinery has been used somewhere other than the business, and then it has been brought in and used in the business. Then maybe to curtail these sort of cases, these provisions or the word first has been mentioned in the additional depreciation clause. Now there are other changes with respect to wherein we are saying about, if you see the current 40 small a, and it has been there since many years, and we have deliberated on that as well. That generally speaking, all the taxes that we pay on the income, we add it back in the tax computation, but specifically if you see 40 small a, it talks about taxes on profits and gains and business and profession. Now that has been considered in the 2025 Act, and it specifically mentioned that any taxes that you pay on the income, that will be added back. Earlier the provision was like the taxes on profits and gains on business and profession. Having said so, practically obviously all the taxpayers used to do the same thing, but now it has been specifically mentioned under the tax law as well in the 2025 Act. There are few changes with respect to when you are paying the salary to a non-resident in India or to a person outside India. There have been certain changes made in that context as well with respect to the allowability of those payment of salaries to non-resident in India or persons outside India. Certain other restrictions has been imposed. Coming into another heads of income from other sources, one important change that has happened here is that if you see the meaning of the word relative, though it has been kept almost the same, but the uses of the word both paternal and maternal has been mentioned, because earlier there was a litigation here that whether the relative, the grandfather or maternal grandfather and all comes under the meaning of the word relative and all. So now this has been set to rest, and there is a clear usage of the words both maternal and paternal. So I think this may avoid a lot of litigation, though there have been court rulings which has read the meaning of the relative word in the same manner, but now by mention of these words, more clarity has been put in the provisions of the law. Now, if you see these changes and all, as we mentioned, these are more structural changes or textual changes and all. It is just simplification of the tax law. Now, maybe as a first step to overall the tax and all, this is indeed very commendable. Having said so, we need to see as to how in the going forward years some more substantive changes are brought in by the legislature, so that it provides tax certainty, simplifies the tax compliances. And one important aspect that most of the clients have also come and said to us, though the tax law or 2025 laws look simpler in terms of readability, having said so, there may not be any relief in terms of the compliances that the tax team or the finance team needs to do, and maybe it will increase a bit rather than reducing, if you see the compliance burden overall. So I think it is the need of the hour that the compliance burden also reduces, and the legislature thinks on those lines. And the last point is obviously the need of the hour is the dispute resolution. I think obviously saying that no policy changes was required to be made here. So nothing on dispute resolution and all, and we all know that there are times wherein some of the appeals which are pending at the first appellate authority, the hearings or the disposals are not happening for years and maybe in some cases decades as well. So I think one aspect wherein few changes are still expected going forward, more substantive changes as to how do we ensure that dispute resolution is also harmonized. I think with this I would request Megha to just take you through line by line of the provisions of 2025 vis-a-vis 1961.
Good evening everyone. Thank you Vikas sir for this insightful introduction, and thank you Vivek sir for the session earlier. It was quite enlightening. So thank you everyone for joining us today for this in-depth session on the comparative analysis. Is there some echo? On this in-depth session on the comparative analysis of the old Income Tax Act vis-a-vis the new Income Tax Act. So in this particular discussion, we are going to cover 6 topics. First topic is the heads of income, and then we'll be moving onwards to the several heads which are there, starting from salaries, PGBP, house property, capital gains, and income from other sources. So if we read the 4800-page document of the Select Committee report, so we'll find one thing which is common for all the sections is that they have mentioned that they did not want to do any policy change amongst the provisions. However, if we read line by line all the sections, we'll definitely see somewhere here and there some fine differences has been, have crept in. And this is going, and we'll have to see that once the law gets into effect from 1st April 2026, how these fine differences are, interpreted by the tax consultants and the professionals, and how the courts are going to deal with these kind of fine differences. So with that, I'll start with the first topic for today, which is heads of income. So in this particular part, in the heads of income, in the new Income Tax Act, 2 particular sections are there, that is section 13 and section 14. So if we'll recall, section 14 of the existing act, this was the fundamental section of the income tax statute because it contained all the 5 heads of income amongst which we are dividing our particular income, and this was the bedrock of the computation of income for all the taxpayers. So section 14 of the existing act grouped the heads of income into 5 heads, as you're all aware. And in the new act also, section 13 does a similar grouping. There were suggestions from the stakeholders to divide this particular 5 heads into as much as 16 heads in order to, include the new types of income heads which has arisen due to digitization of the economy and, modernization of gig incomes, etc. However, the Finance Ministry and the Select Committee categorically told that this is a very radical suggestion, and in any case, we are not looking at any policy changes for the revamping of the income tax statute, and therefore, all these suggestions were ruled down. So basically, if we have to see heads of income, we have to go to section 13 in the new Income Tax Act, and it is basically there are few editorial changes. Apart from that, there are no substantive change in this section, and it has been kept as it is, as it was in the old Income Tax Act under section 14. Now, moving on to the next section, I think which is one of the hot topics for the courts and the litigation, which is section 14A under the old Income Tax Act, but has been now constituted under section 14 of the new Income Tax Act, which deals with disallowance of expenditure incurred in relation to exempt income. So if we see the old section 14A, you will see that there are a lot of provisos and subsections are there because as and when the dispute started evolving, the government thought that it would be good to have some particular caveats in the act itself. Say for suppose assessees used to contend that if there's no expenses incurred for the exempt income, there should be no disallowance. But this was then brought in section 14A itself to provide that even if you do not have any expense incurred, then also section 14A would apply. So section 14A got a little cumbersome due to all these amendments over the years. So now if we see the revamped section 14 in the new act, you will see that is a lot more organized. The language has been made user-friendly, but if we see, then again, there is no substantive change in the new section 14 also. It's same as section 14A of the old act. But if we go through the Select Committee report, one very interesting suggestion which had come from the stakeholders was that they wanted to do away with the AO's intervention in the entire computation of the disallowance. However, it was but obvious that the ministry and the Select Committee struck down this suggestion, and they said that this would lead to tax abuse, and the people would not particularly compute the disallowance in the manner in which the statute intends to, and therefore this particular suggestion from the Select Committee was, or from the stakeholders, was struck down and was not incorporated. So this was all about the first part, that is the heads of income. There are 2 sections, and basically these are the restatement of the earlier sections, and not much substantive changes has been brought here. We'll see that, you know, few transitional provisions were there in 14A, that is the AO cannot enhance or reopen assessment prior to 1/4/2001. So all those transitional provisions has not been, you know, kept in the new act in order to simplify the act and make it more coherent. So that was all about Part A, heads of income. Now we'll move to the next part, which is salaries. So salaries is one of the most common and talked about sections when it comes to individual taxpayers. And starting from section 15, so the section 15 remains same both for the old act and the new act. This is the starting point for salaries. It basically covers, you know, what constitutes salary, advance, arrears, all of this would come under the head salaries. So if we see, there is not much change, neither in the section number, nor there's any substantive change over here. It is kept as it was in the old act. It has been reinstated in the new act. And if we note, one important point is here, is that we are all aware that salary is taxed on due or receipt basis, whichever is earlier. So one suggestion which came up from the stakeholders was that salary should be taxed on payment basis. So the select committee and the finance ministry obviously struck down this particular suggestion. They said that if this is done, then there would be a mismatch of the revenue collection, wherein the employer would be taking the deduction of the salary expense on an accrual basis, whereas the employee would be taxing it on a payment basis. So on account of that, this particular suggestion was also struck down, and section 15, which we now see in the new act, is basically a restatement and a more user-friendly, readable version of the old section 15. Apart from that, there is no change. Now coming to section 16 of the new act. So if we recall, in the earlier act, in the old act, section 16 has all the deductions from salaries. And then if we have to see what actually is salary, then we have to go to section 17 of the old act. So first you have to go to section 17 to know what salary, then you have to come back to section 16 to see what are the deductions. So in order to improve the sequence of the act per se, now what they have done is, in the section 16, they have provided what actually salary is. So the components are exactly the same. There are no changes in the components. If we see whatever perquisites, profit in lieu of salary, whatever there was in old section 17(1) has been reinstated in section 16 of the new act. So that was all about section 16. If we come to section 17, in the old act, if you all recall, section 17 had 3 major components. One was 17(1) salaries, 17(2) dealt with perquisites, and 17(3) was profits in lieu of salary. So now, to improve the readability and make it more user-friendly, now what they have done is they have bifurcated all these 17(1), 2 and 3 into 3 different sections. So now we have 17, 18 and 16, 17 and 18. 16 deals with salary, which you already spoke about, and then we have 17 for perquisites and 18 for profits in lieu of salary. So coming to section 17, perquisites. So section 17, what we'll find is basically the restatement of the old law. One particular change over here is that in the old law, there was an exemption for COVID-related medical expenses, which was reimbursed by employer. So that has been removed in the new act because it is no longer relevant in the present date. So that is one of the changes. Apart from this, if we recall, perquisites were contained in 17(2), and all the rules relating to that were contained in rule number 3 of the Income Tax Rules 1962. So that has been kept as is the old act, and the rules are yet to be prescribed. But since they are not looking at any policy change, so we anticipate that whatever rule 3 is currently there in the income tax rules, that is going to be reinstated once the rules are drafted for the new Income Tax Act 2025. Now coming to section 18, which is the erstwhile section 17(3), it deals with profits in lieu of salary. I think Vikas sir already told us that, you know, a lot of items which are earlier classified under profits in lieu of salary as exemption, now that they will be available as deductions under section 19. So we'll have to include it in our income, and then we'll have to exclude it as deductions instead of getting an exemption in the first place. And apart from this, one other change which they have done is that earlier we have to scramble between section 10, section 16, section 17 in order to find out, actually what goes into our salary and what deductions do we get. So now what they have done is they have introduced section 19, which is pari materia to section 16 of the old act, and it contains all the deductions from salaries. So one very user-friendly thing which they have done is that they have compiled it everything into a readable table now. So instead of just going between the lines and just jumping between the sections, now we get a very comprehensive table under section 19, which we can refer to get an understanding of what deductions do we get from our salary. So apart from this, while going through the select committee report, one very interesting suggestion which the stakeholders had made, although it never made it to the Income Tax Act, was that the employees who get notice period pay and they have to pay to the employer, that should be allowed as deduction from salaries. But this suggestion was not accepted by the select committee or the finance ministry. They said that it is merely an application of income and not per se a deduction from the salary. So this suggestion was struck down. So this was all about salaries. So this was all about salaries, which is basically section 15 to 19 of the new Income Tax Act. If I have to summarize, there has been a rearrangement of sections. One very good thing which they have done is that everything has been consolidated. Now I don't need to go to section 10 to find out what exemptions or deductions do I get. I can just refer this particular part and find it out. Apart from that, they have not done any substantive change. Few changes I think were highlighted by Bikash sir regarding that entertainment allowance, which was earlier available to government employees, but they are no more available in the new Income Tax Act. But apart from that, no major substantive changes, although a lot of suggestions had come, but no major substantive changes has been done in this part as well. Okay, so now we move on to the next part, income from house property. So this basically spans over section 20 to 25 of the new Income Tax Act 2025. And it forms part C of the particular chapter which we are discussing right now. So if we see section 20 basically corresponds to section 22 of the old act. So apart from section realignment, there are no major changes in the old act vis-a-vis the new act. They have tried to keep it, the entire chargeability section, they have kept it same as it was in the old act, that is whatever buildings or lands are pertinent thereto are going to be charged under the income from house property section. And there were amendments relating to PGBP, which has also been incorporated under this particular section in the new act. So nothing has changed from the old act apart from section number. Now during the drafting of the new act, a particular error was found by the select committee, which was that for houses occupied for business and profession, they had used the word as occupied for business and profession instead of using the word as he may occupy, which is there in the present act. So this would have led to unintended consequences where I had a property which was ready to be used for business and profession but was not actually being used. That would have fallen out of this particular provision. So this particular suggestion was accepted by the ministry, and they had again changed the language back to as he may occupy. So particularly these changes which were accepted and these instances show that why this particular review was important, so that unintended consequences of languages are ruled out to the extent possible. So next is section 21, which corresponds to section 23 of the old act. This deals with the determination of annual value. Again, this is same as it was there in the old act. The higher of the reasonable expected rent or the actual rent is to be considered, And if the property is let out, then the actual rent, as it may be reduced by the reason due to the vacancy, that has to be reduced from the annual value. So over here also, when the bill had come, there was a particular phrase which was added for the vacancy allowance. It was said that if it is in the normal course, then the vacancy allowance would be available. So for this also, the stakeholders suggested that if this particular phrase normal course is added in the section, then it would again lead to numerous litigations as to what normal course means. And they also pointed out that there are case laws, that is in the case, they have Bombay Tribunal case laws in case of Sachin Tendulkar and Meta Oxide, that if the assessee is able to show that they had made efforts to let out the property and still it was not let out, then the vacancy allowance has to be provided. So given all these suggestions, the Select Committee and the Ministry of Finance finally agreed that the phrase as occupied should be reinstated back to as he may occupy, which is there in the current act. So the next section in this series is section 20. Apart from this, section 21, there's one more change. In the old act, we just have taxes paid to local authorities. So here they have clarified that this will include any service taxes also. So this is a fine line of difference between the old and the new act. There are no major changes over here as well. Apart from this, we have section 23, which corresponds to 25A and 25B of the old act. Again, this deals with the arrears of rent and unrealized rent. Again, no changes. Select Committee also accepted the provisions on an as-is basis and no particular changes were made. Now, section 24 of the new act corresponds to section 26. Here, Bikash already highlighted that there was a fine line of difference, that instead of so here the Select Committee had recommended that instead of property owned by co-owners, there was a suggestion to change the heading. However, the ministry clarified that the current heading is appropriate and also no major changes was made here as well. Apart from this, we have the remaining section 25, which deals with the definition of owners, and this basically corresponds to section 27 of the old act. Again, here no major change was done and this was accepted as is by the Finance Ministry. So this sums up our income from house property discussion, which spans from 20 to 25. If we have to sum up that what major changes have come here, so there are no substantive changes. Few fine line of differences we noticed here and there for municipal taxes and for property code. So apart from all those changes, no major substantive change has been brought in this particular section. So now we move to the one of the most important and complicated parts of the Income Tax Act, which is profits and gains from business and profession. So as we all know that profits and gains, PGBP is a very vast subject when we, and especially for us tax professionals when we are dealing with the clients, I think these are the go-to sections which we have. So in order to give an overview of what basically has changed in PGBP, so while there are a lot of fine differences, and if we literally read both the acts side by side, only then we'll be able to find out and note all these differences. So apart from those differences, it is also important that we understand the construct of the sections, because in our day-to-day discussions, now we are very familiar with what section 37 is, what section 44AA is, 44AB is. So now that familiarity will not be there, and we need to be accustomed from what the construct of the new act is. So if we just go through how the construct has changed. So if you recall, in the Income Tax Act, the PGBP sections were clubbed under sections 28 to 44DB. So now in these, due to various amendments which has been made in the course of years, So a lot of provisos have been inserted, a lot of section numberings like 44AA, 44AB, all those sections, subsections have come. So the entire PGBP section has become quite cumbersome, and it gets sometimes a little difficult to navigate between the sections. So in the new Income Tax Act, now they have made the entire PGBP section very concise. Wherever they found it difficult, they have introduced tables, they have introduced formulas, and if you're aware, there was an FAQ which was introduced by the government, wherein they had mentioned that what changes they are bringing. So in that FAQ, when they were asked that in PGBP section, what's the vision, what change you are trying to bring. So over there also they had clarified that in the PGBP section, what we are trying to do is we are trying to make the law coherent over here. We want the taxpayers and the tax professionals to find it user-friendly to read and navigate through the sections. And for instance, WDV was enshrined in section 43 of the Act. So now they have given a formula for WDV so that it is easier for a layman to understand that what actually the formula for WDV is. So the drafters have made a conscious effort to bring clarity and order to the law by reorganizing and renumbering the sections. So if we see the PGBP entire code, it starts from section 26 and it goes on to section 66. So the first is obviously the charging section, and then we move towards the various deductions, and towards the end we have the presumptive taxation, which was earlier also a very complicated area for the PGBP part, but now what they have done is they have summed up everything in a table which will be very easy to navigate and to look at. So that was mostly about the construct. Now if we see some of the fine differences which have been there in the PGBP provisions, is that number one, which I think was already discussed, I'll just briefly take you through. So if you recall that section 28, which basically defines that what constitutes business income, it has section 28 3A to 3E, which lists down various export incentives, and it is very specific in nature. So what was happening was there was disputes on taxation of some export incentives which was not covered particularly under section 28. So now when they have introduced section 26 in the new act, so what they have done is in order to reduce the litigation, the new section provides for the taxation of the amount of any cash assistance against export duty drawback or duty remission or any other export incentive which is received. So now if earlier if some scheme was not covered under section 28, that people used to contend that this will not be taxable, but there's no room for those kind of litigations anymore. They're very clear that export incentives of any kind would be covered under this particular section. Now, one very important suggestion which came from the stakeholders, and I think this is a hot topic for litigation also, was that they should exclude loan waivers which are being done under the Insolvency and Bankruptcy Code from the purview of PGBP. So over this, what is important to note is the comments which came from the Finance Ministry. They said that the loan waivers are taxable in light of the Indian accounting standards, and they also refer to some case laws. So when we speak of accounting standards, they refer to Ind AS 109, para 3.3.3. They said that loan waiver, according to this particular para of this particular Ind AS, loan waivers are to be routed through the statement of profit and loss account. And apart from this, they also made reference to the Delhi High Court decisions in the case of Logitronics and Rollitainers. And apart from that, Bombay High Court decision of solid containers was referred. And they said that basis the Ind AS and these judicial pronouncements, the loan waivers are to be taxed under the Income Tax Act, and therefore the stakeholders' suggestion was not accepted as far as the loan waivers are concerned. Apart from this, there were few drafting errors when the bill had come. For instance, they had used the word input license instead of import license. So the select committee had recommended to rectify it, which was done. And a clawback clause was missed out in the drafting, which was that in case assets for which deduction was allowed under section 35 AD, so for that, clawback provision was not provided for, and after the select committee's recommendation, this particular change was accepted by the Ministry of Finance. Now moving on, one other very a very notable change which is there is in section 28. So section 28 deals with deductions for rent, repairs, taxes and insurance. This basically merges two old sections, section 30 and section 31. So in this particular section 28, what we'll see was earlier when the act had come, so they had inserted a phrase if this particular expenses has been incurred wholly and exclusively for the purpose of business. So when the stakeholders suggested, they told that this particular phrase wholly and exclusively should not be inserted in this particular section, and therefore one other clause was inserted wherein they had said that if there's a mixed use of assets, that is assets is used for the business purpose and some non-business purpose also, then the AO has been empowered to do a proportionate disallowance for the expenses which has not been used for the purpose of business. So this particular amendment over here is important because although in the old act the intention was always the same, that is only the business purpose deduction is to be allowed, but the old act never contained any clause for proportionate disallowance over here. So this is a very important change in section 28, and this might be a reason for litigation going forward as to because now the taxpayers would contend that what is proportionate deduction, there is no formula for it, so how is to be calculated. So all those can lead to litigation going forward. So these were some of the changes. Apart from this, when we were going through the voluminous provisions related to depreciation, we noted few changes over there also, although it might not have any substantive outcome, but these are fine line which we can note. So number one, I think Vikas sir has explained that first put to use, the word first has been inserted. The other thing was when we were going through the old provisions and the new provisions, what we noted was there's a phrase in the old act that it is wholly and exclusively used for the purpose of business. So earlier this wholly and exclusively phrase was only for tangible assets and not for intangible assets. Although the intention was always the same that both the assets should be used for the purpose of business only. So now they have inserted this phrase wholly and exclusively used for the purpose of business for intangible assets as well. So that is one other notable change. Apart from this, the presumptive taxation schemes, and if you recall recently amendment for electronic manufacturing facility was there in 44 BBD. So they have clubbed all those in section 61. And then we have section 62, 63, which corresponds to 44 AA and 44 AB of the old law. And this is basically a restatement. A lot of drafting errors were there when this section 62 was being drafted, and this was during the review of the select committee. All these were rectified. I think this was earlier discussed that in the tax audit provisions there was a suggestion to include cost accountants as well to conduct the audits, but this was not accepted, stating that it would tantamount to a policy change. So yeah, this was all about PGBP. So to sum up, while we have a few fine line of differences and once the law is effective, we need to see how these differences are interpreted, and if the government comes up to clarify that these are unintended consequences of redrafting the law and actually there is no change in the law. So that needs to be seen once the act is put into place and put into practice by the taxpayers. So that needs to be seen. Other than that, PGBP is more or less substantively the same as that was in the old act. And there has been a lot of rearrangement of sections, tables have come up, formulas have come up. So that is a welcome approach. It will help the taxpayers to navigate through these particular sections in practice.
Here the ministry was receptive of the technical mistakes or technical challenges and all, but they had a firm stand that they are not going to make any substantive changes and or any policy level changes.
Okay, so moving on, now we come to capital gains. So capital gains is one of those areas which have recently, they have seen a lot of changes, and we were going through the entire fine print of the new act as to see, whether they have captured everything or not. So what we could see that more or less everything which, the amendments which have come recently, everything has been incorporated under the new law. The construct has been changed. If we see the old provisions, it was ranging from between 45 to 55A with a lot of, subsections, provisos, here and there, and a lot of A's and B's to the section. But now what they have done is they have changed the entire construct of the capital gain provisions. In the new act, the provisions begin from section 67, which lays down the chargeability of the capital gains. It basically corresponds to section 45 of the old act. And from there, the new act follows a much more logical and a user-friendly sequence. So section 67 was all about the chargeability, and then we have section 68, which basically deals with capital gains on distribution and liquidation. So it is basically the restatement of the old 46 of the act, and no substantive changes have been made here as well. Now we move on to section 70. Section 70 basically provides an exhaustive list of transactions which are not regarded as transfer, and this basically corresponds to the old section 47 of the act. It includes all new types of reorganizations, business reorganizations, which we could see earlier in section 47, and this has been reinstated in section 70. The select committee also did not have any major issues on this, and this provision was accepted on an as-is basis. Then we move to section 71. Again, this deals with the withdrawal of exemption provisions, which we found in the section 47A of the old act. This basically deals with if the conditions for some exemptions are violated, then what would be the taxability. So similarly, here also we do not see any major substantive change, and just the wordings have been simplified, and whatever there was in the old act has been reinstated in the new act. Then we come to section 70 to 74. These deal with the computation and the cost of acquisition of the capital gains. Section 72 corresponds to section 48 of the old act. So the new act simplifies the language and structure, but it retains the core principles: deduction of transfer-related expenses and cost of acquisition improvement. All of these particular sections has been kept under the new law as is basis, and there are not major changes. What is important to note here is that select committee recommended two key drafting improvements here. Thank you. So select committee recommended two key drafting improvements here. Number one was changing, over there one of the phrases were used, that is the amount, when they dealt with the cost of acquisition. So the select committee recommended to changing the amount phrase to such amount for clarity in the reduction of cost of acquisition for business trust receipts, and restoring the explanation regarding currency conversion for non-residents. As you all know, there's a proviso in section 48, first proviso, it deals with giving forex benefit to non-residents. So some of these suggestions were made by the select committee, and the ministry acknowledged that these suggestions would help make the law more lucid, and these were accepted. Moving on to section 73, this particularly corresponds to section 49 of the old act, and it deals with the cost of acquisition in various modes of acquisition, such as inheritance, gift, amalgamation. The new act, what it does, it presents these particular provisions in a tabular format for better clarity, and corrects several drafting errors which were identified by the select committee, such as there were some incorrect section references. So all those are corrected, and now we have got a very lucid and a very compact table in section 73, which helps us navigate through all the particular situations which was there in section 49. Apart from this, we have section 75 to 91, which deals with the other provisions, basically the stamp duty value, the FMV of unquoted shares, exemptions on reinvestment, what is the meaning of cost of improvement. So all of these have been kept as is. There were various transitional provisions in the capital gain provisions. Some of them have been removed because they were redundant. Some of them had to be kept because the litigations are ongoing and they could not remove it. And one more important suggestion was that the 1/4/2001 deadline, which is currently there in the act, they wanted to change it to 1/4/2021, but again that particular suggestion was struck down because it tantamounts to a policy change, and it would have led to a lot of ramifications. So that particular suggestion was also not accepted. Which was there in 55(2)(a)(c). So all those have been reinstated in the new law. So if we see, section 84 is the new provision in the new act, which corresponds to 55, and we went through all those grandfathering provisions which were there, 55(2)(a)(c). So we found that it is reinstated in the section 84. So that sums up our capital gain taxation. Frankly, we did not find any particular substantive change here as well, but the flow of the sections and the tabular format which they have given for various provisions, those were found to be very user friendly, and apart from that, no fine differences were found here. Now,
I think if you see the entire structure of the 2025 Act, as I said that though there has been reduction in the words or there has been reduction in the number of sections and all, but if you see there has been increase in the number of tables which is there in the 1961 Act. Suppose there are only 18 tables vis-a-vis 57 in the 2025 Act. And also the formulas, there are hardly any formula driven sections, only 6 in the 1961 Act. Having said so, there are almost 50 formula driven sections in 2025 Act. So because of simplifications, you will find lot of tabular formats being incorporated in the 2025 Act, as well as a lot of formulas given for ease in the better understanding.
Thank you. So now let's move on to the last topic of our discussion. So our last topic for today is income from other sources. So this particularly constitutes part F of the new Income Tax Act, and it deals with income from other sources, specifically sections 92 to 95 of the old Act. So basically what we found in 56 to 59 is now here in sections 92 to 95. So if we begin with section 92 is the charging section for income for other sources. So particularly even in this section there are no substantive changes, but what is crucial here is that a lot of suggestions kept coming from the stakeholders and how they were dealt with. So that would be one of the interesting aspects here. So if we start with section 92, it's a charging section for income from other sources. It corresponds to section 56(1) of the old Act, and basically provides that any income not included anywhere in the other heads of income shall be chargeable under the head income from other sources. So here also the language has been updated for clarity, and various cross references which were earlier there in the old Act, that has been modernized to make the law more coherent and more readable. This particular 92(1) was reviewed by the Select Committee, and they did not found any particular comments on this, and this was accepted on an as-is basis. Now coming to section 92(2). So 92(2) enumerates specific incomes that are chargeable under the head. These include dividends, winnings from lotteries, interest income, and so on and so forth, which we found under the old Act as well. So the new Act, what does the new Act does is that it consolidates and updates the list to include recent additions, such as distribution from business trusts, receipts from life insurance policies, virtual digital assets. So all these were not included in the list, and we found it scattered in the statute somewhere. So now what they have done is, when they were curating the particular list under section 92, so they have included all these particular sources of income under this particular list. So basically this reflects the government's response to the emergence of new asset clauses and financial products, and which we already discussed. You know, there was a discussion to expand the heads of income. So while that has not been done, but we see that the government is acknowledging that new sources of income are coming up, and these have been included in the section 92. So here the Select Committee had specifically recommended the inclusion of virtual digital assets and greater clarity on insurance receipts, both of which were incorporated. And apart from this, the structure and language have been simplified, but the thresholds and definitions are largely retained from the Income Tax Act 1961 itself. Now coming to section 92(m), which deals with gifts and property received. So this is a particularly important area. It deals with taxation of gifts and property received without or for inadequate consideration. This provision mirrors section 56(2)(7) and 10 of the old Act, which used to tax gifts of money, immovable property and other property, including virtual digital assets. The thresholds such as 50,000 limit and the 10% of consideration rule for immovable property are retained. The Select Committee received multiple stakeholder requests for carve-outs such as rights or bonus shares. which today one of the hot topic for litigation in M&E is 5627, wherein we say that rights issue, or 5610, where we contend that rights issue or bonus issue should not be particularly taxed under income from other sources, because these are not for anti-avoidance, and basically these are rearrangement schemes. And we also see tribunal case laws here and there which keep coming on 56.210, that is, these provisions has been introduced as a tax avoidance measure and not particularly to tax genuine transactions like a right issue or a bonus issue. So we keep seeing litigations on this. So basis that stakeholders had requested for carve-outs for rights and bonus shares and transactions for IBC, because these are bona fide commercial transactions and they are not per se anti-tax avoidance measures. However, the ministry and committee rejected these suggestions because these are policy changes, but it will be relevant to see that going forward whether these changes which are the need of our, basically these are introduced or not. Now apart from that, let's move on to section 92.3. 92.3 lists the exemptions from gift taxation, such as gifts from relatives on marriage, by inheritance, etc. So we have already discussed one particularly important change here was the definition of relatives. Now they have amended the definition to include both maternal and paternal lineage for ascendants and descendants. So this was a long-standing ambiguity in the old act, which has now been cleared in the new act. The select committee recommended this clarification to avoid litigation and to ensure that the law is unambiguous going forward. Now apart from this, another technical but important area is the valuation of property, especially for business trust units and immovable property. The new act provides that the fair market value for listed unit is based on the last traded price, maintaining objectivity and reducing the risk of litigation. Now, the suggestions were made to use the last valuation report, but the same was rejected by the ministry, who cited the objectivity and definitiveness of going with the traded price. Next, we have section 93. So, section 93 deals with deductions. The new act provides a more detailed and structured list of allowable deductions under IFOS. These include commission or remuneration for realizing dividends, family pension, and other expenditure wholly and exclusively for earning such income. For certain types of income, such as those under 92.2A, flat 50% deduction is allowed with no further deductions. A significant change is in the introduction of cap on interest expense deduction, which was made in the old act, so that has been kept in the new act as well. And apart from this, select committee is concerned about excessive claims of interest expense which are being used to reduce taxable income. The committee made these suggestions. However, the same was not accepted because of being a policy change. Apart from this, if we see no further substantive changes were made here. Whatever was there in the old act has been actually reinstated. In this, I think section 94 is the next section. And section 94 talks about the amounts which are not deductible in computing income from other sources. Again, it was just a reinstatement of what the old law is. They have just tried to simplify the language to make it more to make it more readable and coherent. And the last section here is the section 95, which corresponds to section 59 of the old act. The select committee concurred with the retention of the original intent and the textual simplification, and we just have the new provision as the old provision was, without any substantive changes here. So this sums up our discussion on the heads of income. So if we see, as you've already spoken, there are fine line of differences here and there, and we could also, find out those differences, when we were, literally reading the old act vis-a-vis the new act. Otherwise, if we just, on a overall reading, those won't come out. So on a fine reading, these differences that have come out, and it should be seen, how these differences are interpreted going forward when we put the act to practice next year, and how government responds to it. Other than that, the most welcome thing is that they have made the law user friendly. Tables have come up, formulas have come up, in capital gains also, the deductions table, the table which dealt with, cases where violations were made, that table is very user friendly. Earlier it was very difficult to navigate through all those provisions. In depreciation also, the WDV formula has come up. So all those are very welcome changes, and apart from that, let's see how these differences are dealt with. And once the rules come up, a lot of discussions would be done then also, how the rules compare to the old rules. And yeah, that's all on the heads of income.
Yeah, thank you, Megha. I think nicely summed up, as we have seen that the changes are primarily textual. Having said so, the changes here and there, like one changes that we can speak on income from other sources. If you see the meaning of dividends in 56(2), which is now in 92(2), currently it mentions dividend, but in 92(2), in 2025 Act, it mentions any dividend. Now, does it mean that that other amounts which are strictly not dividends can come under the ambit and all? So maybe these are the small changes we need to be mindful of. Suffice to say that there is no denying the fact that the law has been simplified. Now we just need to see whether the taxpayers' life also gets simplified when they visit tax office, and what is the preparedness of the tax department, on-ground tax officers and all to carry out these changes. Having said so, we'll also need to see how the forms and all the rules shape up. But I think to start with, it is a commendable change, the new Income Tax Act 2025, and I think we should just knuckle down and increase our preparedness now, and it's just a matter of time when I think when the rules and forms and all come, we'll have to really put in our efforts to see as to what is the last minute things that we need to do, and already alluded to by Vivek as well in the concluding part of the discussions. Couple of challenges. I mean, I think we also need to work together with the tech guys as well. There will be a lot of requirement to do the system changes and all, and I am sure that tax expertise and or technical expertise is the need of the hour, because currently maybe other than the tax guys are also aware of 194C, 194I or 194J. That may not be the case going forward for the tech guys, and I think thus it is very important for each of us that even though those tax guys or people who are implementing in the software and all, at least a tax expert's guidance is always there. Yeah, that's all. Thank you. Thank you very much.
Yeah, so since if we look at the revised language of the new act, so they are saying that any form of cash assistance which is pertaining to export would be covered. So these schemes would also be now considered taxable. So since it's a new domain, it needs to be seen how it's interpreted, but from the prima facie look of the new law, these schemes would be included under section 28. Yes, sir. So those schedules are still there, which deals with approved gratuity fund and whatever the approved funds were there. So those schedules are still there. And now what they have done in the new act is that, say suppose we had section 16 in the new act which provided, and section 10 which referred to all those schedules at schedule 3, 4, whatever income is. So, sir, that is there in the schedules in the new act. Yes, sir. Thank you. Do we have any other questions?
Any more questions, even who are online? You can turn on your mic, please.
Ma'am, this is Ayush Trivedi. Ma'am, I just had a query. As ma'am mentioned during the presentation that there are roughly 50 formulas in the new act, right? So, what are the new, is there any new formula which has been introduced with respect to any exemption or any deduction, or what is the framework of those new formula? Or most of them have been covered from rules itself. So if you could shed some light on that part, it would be great.
Will you please turn on your video, please?
Yeah, sure.
Yeah. Thank you, Ayush. So as far as we have, gone through all these formulas, what we see is that they do not intend to change the treatment which was done under the old act. They basically, they are trying to consolidate and concise what was written in the old act. So for that, the formula is given. So I can give you an example. Say the formula which is given for WDV. So in 43(1), we all know how WDV is computed. We have the cost of acquisition, we add all the taxes over there, then, in case someone has paid me the amount of the asset, then that is reduced. So all of those is there in verbose in section 43. So now they have given a formula for that. So it basically does not change the treatment, but it will make the, reader more, it is made more reader friendly and more taxpayer agnostic. Apart from that, they do not intend to change the treatment which was there in the old act. That was never the intention of the act itself. I hope I've answered your question. Thank you.
Any more questions? Thank you. We are closing today. Tomorrow we will start at 2:30. For online participants, we have already shared the link. We will share it again today evening along with the presentations. And for the participants who are here, tomorrow we will have our session at the ITC room, first floor from 2:30. Thank you.